You borrow $10,000. The bank smiles. The paperwork is smooth. Interest is low, almost polite. Then someone else borrows $10 trillion. No smile, no paperwork. Markets celebrate. That's the uncomfortable truth most people never sit with. Some debts are treated like a disease. Others are treated like gold. Same word, completely different reaction. And once you see why, you can't unsee it. Because this isn't about responsibility or morality or even money the way you think about it. It's about power, structure, and a quiet math trick hiding in plain sight. And right now, this matters more than it has in decades. Because global debt is exploding, interest rates are no longer asleep, and the line between safe debt and dangerous debt is being tested in real time. Let's start somewhere familiar. Imagine a household. You earn a salary, you borrow to buy a car, maybe a home. If your debt gets too large relative to your income, things get tense. Payments eat your paycheck. Unexpected expenses become threats. The risk is obvious. Miss enough payments and the system punishes you. That logic feels universal. But then you zoom out. A corporation borrows billions. An entire country borrows trillions. And suddenly the rules feel inverted. Some borrowers are treated like ticking time bombs. Others are treated like the safest place on earth. Why? Because not all debt lives in the same universe. Let's simplify the landscape. There are three broad borrowers that matter here: households, corporations, governments. Household debt is simple. You borrow future income you haven't earned yet. Your repayment depends on one fragile thing: your job. Lose that, and the math collapses. Corporate debt adds a layer. Companies borrow against future profits. They can raise prices, cut costs, fire people, sell assets. Still risky, but flexible. Government debt lives somewhere else entirely, because governments don't just earn money, they define it. And that single fact breaks most people's intuition. When a government that controls its own currency borrows money, it isn't promising to earn dollars later. It's promising to create them if necessary. That doesn't mean there's no cost. It means the risk looks different. This is where the confusion starts. People hear trillions in debt and imagine a giant credit card waiting to explode. But markets don't see it that way. They ask a different question. Not how big is the debt, but can this borrower always pay? And for some governments, the answer is boringly yes. Take U.S. Treasury debt. Trillions outstanding, growing every year, yet treated as the closest thing to risk-free on Earth. Why? Because it's issued in dollars, paid back in dollars, and the U.S. controls the dollar. If necessary, it can always print more. Again, that doesn't mean it's painless. It means default, in the traditional sense, is unlikely. Contrast that to a country that borrows in a currency it doesn't control. Now the math changes completely. If your debts are in dollars, but your economy earns pesos, you're exposed. You need foreign currency. You need trust. You need markets to keep lending. Lose that, and the debt turns poisonous overnight. Same debt word, different physics. This is why markets treat some debts like gold and others like dynamite. But here's where it gets uncomfortable. Even safe debt isn't actually free. The bill just shows up differently. When a government prints money to manage its debt, it doesn't send you an invoice. It dilutes purchasing power. Quietly, indirectly, politely. No missed payment notice, just higher prices. Inflation is how safe debt gets paid. Not always immediately, not always dramatically, but inevitably somewhere in the system. And this is where the irony kicks in. The same investors who panic over household debt ratios will happily buy government bonds yielding less than inflation. They're accepting a guaranteed loss in real terms. Why? Because safety isn't about returns, it's about certainty. In a crisis, they don't want growth, they want survival. Government debt from powerful issuers becomes the financial equivalent of dry land during a flood, even if it's slowly sinking. Now let's zoom out. Why does this matter right now? Because for over a decade, this entire system was anesthetized by low interest rates. Debt was cheap, refinancing was easy, mistakes were hidden. Then rates woke up. Suddenly, debt started charging rent again, and the difference between safe debt and dangerous debt became visible in real time. Households felt it first, then companies, then governments. Some governments are spending more on interest than on defense, or healthcare, or education. Not because the debt is new, because the cost of debt changed. And here's the hidden mechanism most people miss. Debt isn't dangerous when it's large. It's dangerous when it grows faster than the system supporting it. A growing economy can carry growing debt. A stagnant one cannot. That's the real math. If your economy grows at 2% and your debt costs 5%, the gap compounds against you. Slowly at first, then all at once. This is where hype and reality diverge. The hype says governments can just print forever. Reality says printing shifts the burden, from bondholders to citizens, from balance sheets to grocery bills. No explosion, just erosion. And erosion is politically harder to manage than default. Which brings us to the quiet risk nobody likes to talk about. Trust. Safe debt is safe because people believe it is. The moment that belief cracks, the system doesn't fail politely. Interest rates spike, currencies slide, refinancing becomes impossible, and suddenly yesterday's gold debt starts behaving like tomorrow's trap. History is full of these moments. They don't announce themselves. They arrive disguised as confidence. So when you hear that this debt is different, it usually is, just not in the comforting way people mean. The real divide isn't between good debt and bad debt. It's between debt backed by credibility and debt backed by hope. Credibility comes from institutions, productivity, and power. Hope comes from assuming tomorrow will fix today. Markets can smell the difference, and they reprice it brutally. Which leaves us with the final uncomfortable question. If the safest debts in the world are being paid for through inflation, and the riskiest debts collapse through default, who actually pays in the end? Bondholders? Taxpayers? Consumers? Or a future generation that never signed the contract? Because once you understand why some debts are treated like gold, you start noticing how quietly the cost is being passed along. And that raises a final thought worth sitting with. If debt is only safe as long as people believe in it, what happens when belief becomes the scarcest asset of all?